Artificial intelligence is all the rage these days as AI continues to take the world by storm. For instance, nearly 40% of the S&P 500 mentioned AI in their latest earnings calls, with executives bragging about how they will be beneficiaries of this new technology. Palantir is no exception to the AI hype, and after launching its AI platform back in April, the stock took off, rallying more than 150% this year alone. Without a doubt, AI is a major catalyst for Palantir's rally and is probably one of the only things keeping the rally alive. So in today's video, I want to talk about Palantir stock. I'll go over its Q2 results, valuation, and whether it's worth investing in this AI-powered stock. As always, you can find the article version of this analysis in the description box below, where I cover Palantir in much more detail. We got a lot to cover, so let's not waste any more time and jump right into the video. Looking at Q2 results, Q2 revenue was $533 million, which is up 13% year over year, which was in line with analyst expectations and slightly above the high end of management's guidance. As you can see, growth continued to decelerate, with Q2 marking the lowest revenue growth rate in the history of the company, which is quite concerning because a lot of people regard Palantir as this hyper-growth disruptor, but it's only growing 13% year over year, so a bit of a reality check here. And it's just safe to assume that Palantir may never return to its high growth days of posting 30% plus growth. That said, the slowdown in growth was primarily due to the lagging commercial segment, which produced $232 million of revenue in Q2, which is up only 10% year over year. US commercial revenue was $103 million, growing by 20% year over year, which is the gray line right here, maintaining strong momentum in the US. On the other hand, international commercial revenue only grew by 4% year over year to $129 million due to weak growth in Europe. Poor growth in the commercial segment was also due to a $14 million sequential decline in revenue from strategic commercial contracts, which are the spec companies that Palantir invested in. Most of these companies are unprofitable, so I'm not surprised to see some of these customers scaling back their investments in Palantir software. With that in mind, excluding these spec contracts, commercial revenue and US commercial revenue would have grown 19% and 37% year over year respectively. It is also worth pointing out that the commercial segment is facing very tough year over year comps, which explains the sudden slowdown. As you can see, the segment grew by 46% year over year in Q2 last year, and US commercial grew even faster by 120% year over year last year, so tough year over year comps is dragging growth down. On the other hand, government revenue was $302 million, which is up 15% year over year. US government revenue was the laggard here, growing only 10% year over year in Q2 to $225 million due to uncertainty around contract timing. But despite weak growth, the deal pipeline remains strong, with US government total contract value growing 111% sequentially, so that's very good to hear. On the other side, international government revenue did much better, growing 31% year over year to $76 million, mainly driven by the UK, where Palantir signed deals with the NHS, the UK Ministry of Defence, and the Royal Navy. While revenue growth was weak, total customer growth remained strong, growing 38% year over year to 421 customers in Q2. Successfully onboarding customers is the first step to monetizing its platform, and the more customers it lands, the higher the opportunity for Palantir to expand revenue, because over time, customers will eventually spend more on the platform. So the strong growth in customers is great to see. As you can see, average revenue per top 20 customer continues to trend upwards, growing 15% year over year to $53 million in Q2. This is Palantir's land and expand strategy in action, which shows that Palantir customers are investing more and more into the platform, which is why adding more customers into the platform in the first place is so important. With that said, the more customers that Palantir acquires, the higher the opportunity for Palantir to monetize these customers as they grow within the platform. Sure, it will take some time for revenue from new customers to make an impact on the income statement, but overall, strong customer growth today will eventually lead to robust revenue growth in the future, and this is especially important with recent developments in AI. Fortunately, Palantir is in a really good position to capture this emerging AI market with its recently launched Artificial Intelligence Platform or AIP. And the company is already seeing very strong demand for AIP with discussions with more than 300 additional enterprises that could potentially turn into actual customers. As such, I expect strong customer growth in the next few quarters, and that will eventually drive Palantir's growth for years to come. Turning to profitability, Q2 gross profit was $426 million, representing an 80% gross margin, and as you can see, gross margin has been slowly improving over the last few quarters, and this is due to lower stock-based compensation expenses. Other than that, nothing much to talk about here besides the fact that Palantir has a high gross margin of 80% plus, which also shows high earnings potential. Moving down the income statement, operating profit was $10 million in Q2, which represents a 2% operating margin, and this marks Palantir's second consecutive quarter of GAAP operating profitability, as you can see right here, demonstrating operating leverage within the business. Improving profitability is mainly due to lower SBC expenses, and as you can see, SBC has been dropping over the last few quarters, both in absolute figures and as a percentage of revenue. Although SBC remains high at 21% of revenue, the trend is downwards, which means decreasing shareholder dilution risks as well as less pressure on the company's bottom line. And the impact of lower SBC is already evident as the company reports its third consecutive quarter of GAAP net income profitability in Q2, which was $28 million at a 5% net margin. All in all, I love that profitability is improving with each passing quarter, which shows economies of scale and operating leverage. On the other side, SBC remains high, which means ongoing shareholder dilution. However, pressures from SBC is becoming less and less severe, and I expect profitability to continue to improve moving forward. Looking at the company's financial health, Palantir has $3.1 billion of cash and short-term investments. Total debt stands at about $0.2 billion, mostly in the form of operating lease liabilities, and that leaves Palantir with a net cash position of about $2.9 billion, or roughly 10% of its market cap. So very strong balance sheet overall. Free cash flow remains robust with Q2 free cash flow of about $86 million, representing a 16% free cash flow margin. Looks great, but it doesn't seem impressive with an SBC of $114 million in Q2 or 21% of revenue. And to put that into perspective, SBC is 133% of free cash flow, which is not good at all. That's it. SBC dilution is still an issue with shares outstanding growing 3.5% in the past year alone. Everybody knows that SBC is one of the biggest issues with Palantir. Management knows this, and to negate the effects of shareholder dilution, the board of directors approved a $1 billion stock repurchase program. While this sounds good, I was actually pretty confused with the decision. Here's why. First, I think buybacks are reasonable only when the stock is undervalued. The problem with Palantir is that management announced the stock buyback program after the stock has rallied more than 100%. So the company intends to buy back shares at twice the price, which is strange and pretty bad timing in management's part. I like buyback programs, but in this case, I think Palantir should have announced the buyback program a few quarters ago when the stock was trading at single digits. Secondly, given the massive opportunities in big data analytics and AI, I think Palantir should be focusing on reinvesting all their excess capital into the business for organic growth. So that's just my thoughts on Palantir's stock buyback program, if that makes any sense. Turning to outlook, management provided the following Q3 and full year 2023 guidance, but instead of looking at this slide, I've went ahead and compiled management's guidance into a table, including year-over-year growth rates, margins, and what Q4 results may look like based on Q3 and full year 2023 guidance. That's it. Management expects Q3 revenue to be between $553 million to $557 million, up around 16% year over year, which means that growth is set to re-accelerate from Q2's growth of just 13%. Management also raised their full year guidance by $2 million to at least $2.212 billion, which means growth of at least 16% for the full year. With that said, assuming a 555 million revenue in Q3 and 2.212 million revenue in full year 2023, Q4 revenue is expected to be at least $598 million, which is an 18% year-over-year growth rate. So put it another way, Q2 revenue growth is the throw and growth is expected to re-accelerate moving forward. In addition, Q3 adjusted operating income is expected to be about $137 million, which is a 25% adjusted operating income margin. For the full year, adjusted operating income is expected to be at least $576 million, which is a 26% operating margin. This also means that management expects Q4 adjusted operating income of at least $179 million, which is a margin of about 30% if Q4 revenue turns out to be $598 million, which also means that profitability is expected to improve for the remainder of the year, which is great to hear. Furthermore, as mentioned earlier, the deal pipeline remains strong with billings up 52% year-over-year to $603 million and 66 deals signed with at least $1 million. So there's a lot to be excited about Palantir. Also of important note, management expects S&P 500 inclusion following Q3 results, which could be a major catalyst for the stock. With that said, the outlook looks great for Palantir as growth is set to re-accelerate, profitability is set to improve, and the company is set to join the S&P 500. Turning to valuation, Palantir stock is up more than 150% year to date, and now it is not only trading above the 200-day moving average, which is the dark orange line right here, but it is also trading significantly above the 200-day moving average, about 45% above the indicator to be exact, which is quite stretched out, so I won't be surprised if the stock retreats close to the 200-day moving average before its next leg up, probably around the $12 level. In terms of multiples, Palantir now trades at an EV to revenue multiple of about 14.4 times, which is a significant discount from its peak of about 60 times. But this multiple compression is well justified given Palantir's slowing revenue growth, as you can see by the orange line right here. That said, a 14.4 times EV to revenue multiple is not cheap for a company growing at just 13% year over year. However, the markets are pricing in a re-acceleration of growth in future quarters due to recent developments with AI and AIP, thus the recent rally that we've seen and higher valuation multiple today compared to where it was a year ago. Looking at my DCF model, I followed analyst estimates for the first 3 years for revenue growth and gradually dropped growth rates to just 14% by 2032. I think my growth rate assumptions are fairly reasonable given the company's growth opportunities in AI, big data, and escalating geopolitical tension. Cost of revenue will remain at 20% of revenue, as I don't think that Palantir's gross margin will improve moving forward, which is why I set it at a constant rate of 80% right here. On the other hand, operating expenses as a percentage of revenue is expected to decline from 75% in 2023 to just 45% by 2032 as the company gains economies of scale. Income tax expenses will eventually be 20%, and depreciation and amortization will be set at about 1.2% of revenue. As for stock-based compensation, I expect SBC as a percentage of revenue to continue to decline from 20% in 2023 to 7% by 2030 and beyond. And for capital expenditures and changes in net working capital, I will set them at their 5-year averages, which is 1.7% and 3.2% respectively. So based on all these assumptions, I expect Palantir to generate a revenue of about $9.5 billion by 2032 at a 31% free cash flow margin. And here I've also included Palantir's free cash flow profile if stock-based compensation is not added back into free cash flow. That's it. Assuming a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at a fair value estimate of of about $12.94 for Palantir stock, which is slightly lower than the average analyst price target of $13.90. And if I exclude stock-based compensation from my calculation, my price target would have been much lower at just $9.83. With this in mind, I think Palantir stock is slightly overvalued, as you can see by the chart right here. And in my previous video, I mentioned that if the stock rallies to the $15 level, I would start trimming my position, which is exactly what I did. Although the stock may rally further due to reasons such as S&P 500 inclusion, I acknowledge the fact that Palantir stock looks overvalued, and I think the right course of action is to take some profits off the table. I think there's just too much hype baked into the stock, which is why I took some profits. I didn't completely sell out though, which at least gave me some exposure on upcoming rallies. Turning to risks, one major risk with investing in Palantir is shareholder dilution. I've already discussed dilution in detail, so I won't repeat it here, but the point is, shareholder dilution limits upside potential, which is not good for investors. The second major risk is growth slowing down in future years. Growth should reaccelerate in the back half of 2023, but the question is, can Palantir return to high growth mode in the following years with 20% plus growth and justify its high valuation? If not, the markets could give a lower valuation multiple for Palantir, which is going to pressure the stock. My investment thesis on Palantir is that the company is at the forefront of big data analytics and artificial intelligence platforms. Investors are worried that Palantir's growth is slowing down. However, growth is set to reaccelerate in the back half of the year as AIP gains traction. So despite the recent rally, I think there's more upside for Palantir stock due to growth reaccelerating, improved profitability, and S&P 500 inclusion. On the other hand, I think there's some downside due to the recent rally as well as overvaluation. Put simply, I feel pretty mixed about Palantir stock, which is why I trimmed my position. However, I do still think that Palantir is a great long-term investment, but I just think that the stock could take a breather in the short term. So in my opinion, Palantir may not be the best investment opportunity today, but if you're looking for a growth stock with high upside potential, you can click in this video right here where I reveal one of the best buying opportunities today. With that being said, thank you guys so much for watching this video. If you find value in this video, please leave a like, comment, and subscribe to my channel for more investment content. As always, I appreciate you and I hope you have an amazing day. See you guys on the next one.